A dividend stock that I don't see talked about here on YouTube very often is Wendy's, stock ticker WEN. This is a company that's currently trading at $20.53 per share. Now, year to date, they're down 14%, so that's pretty close to what the market has done as a whole. But as a value dividend investor, something that I do always want to look at is dividend growth over time. And if we look at the past 10 years, we can see pretty solid dividend growth. Unfortunately, they did have to decrease their dividend during the 2020 dip, but we can see here it's now at its all-time high. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if Wendy's stock is a stock we should consider buying or selling by calculating its intrinsic value. And on the spreadsheet, we have our 4 valuation models. We have Graham's valuation, a discounted cash flow model, a multiples valuation, and a dividend discount model. So let's go ahead and jump over to our stock screener. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. But what we're going to do is we're going to come up here and plug in the stock ticker for Wendy's and hit enter, and you can see all of this data is going to automatically load in. Now we're currently looking at a 365-day change chart for Wendy's. But let's say we want to go ahead and zoom out a little bit and look at a 1,000-day change. We can see it's been pretty consistent. We had a decline here in 2020 and then a decline here fairly recently. But if we come over here and look at the dividend data, we can see they're currently paying out 50 cents per share, which gives them a dividend yield of 2.44%. Now the payout ratio is currently sitting at about 60% as well, a little bit higher than I typically like to see it, but not necessarily a red flag. Analysts currently have a target price of $23.33, so it's about $3 a share higher than the current price, and the beta for this company is sitting at 0.92, so it's going to be pretty close to the levels of the market volatility. But let's go ahead and look at our first valuation, which is going to be Graham's valuation. And this is a valuation model invented by Benjamin Graham, one of Warren Buffett's mentors and also the author of the greatest investing book of all time, The Intelligent Investor. And in that book, he lays out this formula for us to calculate intrinsic value. So the first thing we need is our earnings per share, which we have for Wendy's right here. We then multiply that by 7, which is the price to earnings of a company with no growth. And then we apply our growth rate projection. And after looking at analyst expectations and just expectations for Wendy's overall, we're applying 11 for our growth rate projection. We then multiply that by 4.4, which is the average yield of AAA corporate bonds. Once we've done all of this, we divide by Y, which is the current yield of AAA corporate bonds. At the time of this video, that is sitting at 4. So when we plug all of this in together, we come to an intrinsic value of $16.04. So despite that high growth rate that we're looking at, the lower earnings per share and the high current yield of AAA corporate bonds is leading to a slightly lower intrinsic value than the current trading price for this company. But let's go ahead and look at our other valuation models and see if that is true for them. The next valuation we're going to look at is our discounted cash flow model. And to perform a discounted cash flow analysis, we want to project a growth rate to the future free cash flows of the company. So in order to do this, I plug in the historical free cash flow for this company, and we can see year over year the growth rates after I've done this. So we can see it's been a little choppy, some years with not much growth at all, and then some years with some pretty solid growth. So over the past few years, we've had an average growth rate of 21.4. Again, pretty choppy here overall, as we can see, but I'm going with an 11% growth rate for the future free cash flows after digging into it a little bit. So I project out to the future free cash flows and the terminal value, which is the sum of the future free cash flows past the year 2030. I then found the present value of these future free cash flows and added them together here, added the company's cash and cash equivalents, and subtracted out their total debt to find their equity value. Once I have equity value, I divide by the shares outstanding to get our discounted cash flow price per share of $27.58. So in this scenario, it's actually quite a bit higher than that current trading price. But let's go ahead and move on to our next valuation, and that's the multiples valuation model. And I really like the multiples valuation model in this scenario because I think we have some great companies to compare Wendy's to. But the idea behind the multiples valuation is we should be able to value a company based on how the market is valuing companies that are similar in structure using a multiple such as the price to earnings multiple. So we take companies like Yum Brands, McDonald's, Domino's Pizza, and QSR. We take their stock price, divide by the earnings per share to get their price to earnings multiple, as we can see right here. We then take the average of those 4 price to earnings multiple and we multiply it by Wendy's earnings per share, which is 0.81. Once we plug all of that in, we get our intrinsic value of $21.67 per share. So that is very close to the current trading price for Wendy's. So what does that mean? Well, if we look at the average price to earnings, 26.7, jump back over to our stock screener, we can see again their price to earnings is very close then to the average price to earnings. So according to our multiples valuation model, it looks like Wendy's is fairly valued. But let's go ahead and look at our next valuation, and that's our last valuation, the dividend discount model. Now, as a value dividend investor, this is obviously a very important valuation for me because I want to see high dividend, well, I typically like to see a high dividend yield. That's not always the case, but more than anything, I want to see dividend growth. So what I've done is I plugged in the quarterly dividend payouts here so we can see how much they pay out each year. And this allows me to see our year-over-year growth rates. And again, we're looking at very choppy dividend growth over the past few years. And again, if we jump back over to that dividend history, if we zoom out, overall, we can see it is good, solid dividend growth over time, but it's been a little bit choppy over the last few quarters. A lot of that is due to 2020. But let's go ahead and jump back into our valuation. We can see they've had an average growth rate of 13.48. I definitely don't think it will be that high in the future, but I think it will be somewhat decent. So I'm applying a growth rate of 5.5%. After taking a discount rate of 8%, we come to a dividend discount model price per share of $21.10. Again, pretty close to that current trading price. But let's go ahead and jump over to our output tab. And here on the output tab, we're going to see all 4 of our valuation models. Grams at 16.04, multiples at 21.67, discounted cash flow at 27.58, and dividend discount model at 21.10. After averaging all 4 of these together, we come to an intrinsic value of $21.60 per share, very close to the current trading price of this company, but it is a little bit higher. But as a value dividend investor, we do always want to apply a margin of safety to our investments. So let's say I'm a little bit more aggressive with my margin of safety. We apply 10%. Based off of this, our acceptable buy price is $19.44 per share, meaning this is not a stock we should be buying. Now, if we jump back over to Seeking Alpha, we can see there's been a lot of opportunities year to date for this company where the company has been below that price. That may be an opportunity if that's your margin of safety. But let's go ahead and jump back over to our spreadsheet, and let's say we want to apply a 30% margin of safety. Based off of that, our acceptable buy price would be about $15.12 per share. Again, meaning it's not currently a stock we should be buying, but I would keep an eye on it because there may be opportunities in the future. As for me, I'm going to add this company to my watch list. I do hate that they had to cut their dividend in 2020. I don't currently plan on adding any shares, and I don't own any shares currently, but again, it's going to be on my watch list, and I will be looking for opportunities if we see a decline in the share price. But go ahead and let me know what you think of this company in the comments down below, if you plan on buying and if you plan on selling. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.